and welcome to Genesis Volatility's educational series. Today we're going to talk about second order Greek derivatives. This will be the first video in a series, and today we'll visit Charm and Vanna. Charm is the change in delta with respect to time, whereas Vanna is the change in delta with respect to volatility. You can think of Vanna as volatility gamma. The reason that we've clumped these two together in today's video is because the change in delta with respect to time and the change in delta with respect to implied volatility are both closely related. When we think of normal distributions, what we're really thinking of is the distribution of things that can happen. And the reason why time and implied volatility are so closely related is because on a theoretical standpoint, they're almost interchangeable. We can allow for more things to happen, essentially increasing the distribution by adding time, or we can keep the same time constraint, but jack up the standard deviation or the implied volatility, which will therefore have more things happen given the certain time constraint. So we either keep the standard deviation the same or the implied volatility the same and allow more time for things to happen, or we keep the time the same and then jack up the standard deviation / implied volatility and fit more things to happen in that same time constraint. So from a theoretical perspective, they're almost interchangeable and they almost have similar effects in these second order Greeks. Now, the reason why I say that they're almost interchangeable is that in reality, from a trading perspective, jacking up implied volatility is a lot more chaotic. Implied volatility is not static or is not smooth and decaying at a certain rate like time is. Days going by is kind of very predictable and steady. Whereas increasing implied volatility, that's a whole different environment and things are going crazy and implied volatility can bounce around a lot. So in a practical standpoint, as a trader's perspective, increasing time or increasing implied volatility are very different. But from a theoretical perspective, talking about distributions, they are pretty similar. So let's visit Charm. What happens to delta if we increase the time until expiration? Well, when there's only a few days until expiration, out of the money options, low delta options are going to be closer on the moneyness surface than far dated options. So what you'll notice is that if you plot two options with different expirations and you look at the delta for these two call options, for example, you'll see that the longer dated option has a lot flatter delta surface than the short dated option, which has a very steep delta surface. Both intersect at 50 delta or around at the money of the underlying. So what this means exactly is that out of the money options will increase in delta as you add time, and in the money options will decrease in delta as you add time. And so this creates a very interesting profile for your options trading. So what happens with Vanna? Well, Vanna has a very similar delta profile. Your high vol environments can have a very flat delta surface, and your low vol environments can have a very steep delta surface, both intersecting around at the money. Now, if you increase vol, your out of the money call options are going to gain deltas, and your in the money call options are going to lose deltas. Increasing vol takes your delta slope and shifts it into a more flat profile. Essentially, if you increase implied volatility far enough, almost your whole call ladder or put ladder becomes at the money. So to recap, the Charm and Vanna of your options has an impact into the wings, but almost zero impact around at the money. So how can we use this from a trading perspective? Well, there's a couple things to keep in mind. I don't know if you've ever noticed, but if you look at an at the money option, which has a higher vega, and you increase the implied volatility, the percentage return to the option to the long option holder isn't as big as a far out of the money option where you increase the implied volatility. In percentage terms, or the price to Vega ratio, for out of the money options is a lot higher than for at the money options. And if we think through distributions, we can see why. If you take a normal distribution and you're looking at the mean or the 50 delta option for that normal distribution, increasing the implied volatility changes the magnitude of the payout, but a 50 delta is still a binary outcome in terms of being in the money or out of the money at expiration. Now, if you look at an option out in the wings and say you're looking at an option that was 3 standard deviations out of the money, but now you've increased implied volatility and it's only 2 standard deviations out of the money, while you've gone from a 1 in 300 chance, give or take, of being in the money at expiration down to a 1 in 20 chance of being in the money at expiration. So the at the money option has no real change in the probability of being in the money, but it has a change in the magnitude of how much in the money at expiration, whereas the out of the money option has a huge shift in probabilities of being at the money. So that's one of the ways you can think of why do out of the money options become so affected in percentage terms to a change in implied volatility. The same thing holds true for the passage of time. If you ever created a 1x2 option structure where you basically buy an at the money option and you sell 2 out of the money options, and you do this for no net cost, meaning your premium purchase is equal to your premium sold, something that you'll notice is that your theta profile of this position, being long the 1, short the 2, is going to be positive time decay. Despite having an equal amount of dollars invested in option decay, in extrinsic value, so to speak, the decay of the out of the money options is going to be a lot faster than the decay of the at the money option. And that's something that you see translated through Charm as well. The decay of the delta of an out of the money option as time goes by is going to be more significant than the decay of a near money option as time goes by. So, taken together, understanding Vanna and understanding Charm will allow you to structure trades and understand the impacts on your Greeks from a steady change in time or steady decay of time going by, or an anticipated implied volatility change. Finally, one last caveat. If you're trading 1x2 structures, those are open-ended risk profiles. It often makes sense to transform that 1x2 into a broken wing butterfly, meaning you buy a far out of the money option to cover your short unit risk, or you can use a short dated option to cover your short unit risk and roll that over. I hope you found this video helpful, and remember, find edge, capture alpha, and slang size.